Hello, everyone, and welcome to our Zoom call today titled Our Annual Market Update in 2023 Outlook, presented by Sullivan Wealth Management here on Thursday, November 10th, 2022. Your Sullivan Wealth Management hosts on this call are Paul Sullivan, Investment Advisor Representative, Raj GOENKA, Investment Advisor Representative, KOBY Clark, Wealth Management Advisor, and last but not least, we have John Rosebrough, Portfolio Manager for the Archer Investment Corporation, who's going to talk first a little bit about principles and opportunities to consider when investing in a market downturn, which is, I think, where we'll start here on the screen.
All right, thanks, Jeff. And thank you all for joining us. Paul, KOBY, Raj, appreciate the opportunity to be here. So I think we'll just jump right in. It's been a challenging market, to be sure. We've had inflation to worry about, the Federal Reserve, market volatility. All those things go together to make it awfully hard for an investor to stay focused on their long-term goals. But if we jump over to that first or that second slide, KOBY, I think there's a few principles, things to keep in mind that'll help you weather and prosper actually coming out of a market downturn. So just some things to keep in mind. For the long run, it pays to own stocks. It can be challenging at times with the relentless amount of news that hits us over the head. But history shows for the average person, there's no better way to grow capital and wealth over the long term than by investing in stocks. Number two, as unpleasant as they may be, pullbacks, corrections do happen with a fairly regular frequency and are to be expected. So just it's hard to keep a long-term view, but we think keeping that long-term view, even along with those corrections and pullbacks, it's important in order to protect your long-term goals and your long-term success. Number four, and this is one of the items that has caused some of the declines in the volatility in the market, but higher rates over the long term do not mean the end to equity gains, the stock market gains. Sure, we have some short-term declines as the market kind of adjusts to that, but over the long term, stocks continue to move higher even with higher interest rates. That leads to number five, volatility, the ups and downs we've been seeing in the market certainly accompanies both increasing rates and midterm elections. So we've been hit with kind of that two-headed monster here recently of a rising rate environment and the typical volatility that goes along with midterm elections. Number six, as tempting as it can be, market timing does not work. Market timers frequently miss out and do a fair amount of damage trying to do so to their portfolios and their long-term success. And then finally, and we'll talk about this at the end, we think there's some creative tactics that you can take a look at and work with your advisors there at Sullivan and Company to take advantage of and make lemonade, if you will, with the lemons that the market gives you. So if we move to the next slide here, KOBY, and I know this is kind of a busy slide, but what this shows is these shaded areas are all declines in the market associated with a variety of bad things or exogenous impacts that investors have to deal with, whether it's a financial crisis, currency crises, wars, pandemics, over time. And again, this is a pretty short view. This is just going back to 2009. But if we look at the long term and think about it, it's the same kind of story. We've had Spanish flu, world wars, Vietnam War, terrorist attacks, all of these bad things that cause some declines in the market. Over time, the market recovers and moves higher from those events, even though, while we're in them, it may feel like we're never going to dig out of it. Keeping a long-term view, staying invested for the long term, historically, the market has recovered from each of those events. If we look at the next slide, this kind of drills down a little more narrowly. And if we look at just 1 year returns, and this is going back to 1926, while we encourage everybody to have more than a 1 year time horizon, even in any single year, the odds are skewed in investors' favor. If we look, there's only been a loss of more than 10%, 11 times in almost 100 years, going back to 1926. But in 75% of the years, the market has a positive return, and in 60% of the years, the market's got a greater than 10% return. So, these are short time horizons, but in any given year, with that skew to the right side of the axis there, returns and the market is in investors' favor over the long term. If you take a look at the next slide, and again, this is kind of a busy chart. I apologize, but what this shows is the returns and intra-year declines for the S&P 500 going back to 1980. So over 42 years. And what we see here is pullbacks, corrections, bear markets, all topics that you'll hear about on the financial news media, happen with a pretty high degree of regularity. So a pullback is typically thought of as a 5 to 10% decline. As you look at these years, so the red dots, at least I think they're red. I apologize, I'm a little bit colorblind, but the red dots, you'll see quite a few of those years where we have 3 to 5% declines. And in fact, most even healthy markets have 3 to 5 declines of 5% or more in a given year. A correction is typically something that we'd think of a 10 to 20% decline. Those happen, more than we would like, but not as frequently as the pullbacks. We see a correction generally every 16 months or so. And then a bear market, which is what we've had at least to begin this year, a 20% or greater decline. Those happen less frequently. And the good news, in a non-recessionary environment, which we're in right now, whether we will have a recessionary environment in the future is still to be determined, not guaranteed, but possible. But those types of bear markets are historically pretty infrequent and pretty shallow bear market declines. But you can see from this chart, we think we have all these great years, which we do, but usually there are some declines in those years. Looking and a couple of recent ones, if you go back to 2020 with the pandemic fueled bear market, we had a 34% intra-year decline, but the market ended up 16%. If you go back a little bit further to the last bear market, 2009, and the financial crisis, we had a 28% decline, but the year ended up 23%. So, most of the time we have positive returns for the full year, but we do have to endure, unfortunately, some of these painful declines in the interim.
Hey, Troy. Troy, this is Bob Catskills. I'm a 1040 client for Sullivan. I just have a quick question. Sorry to cut you off here, but so while we're on the topic of the S&P, so my investment account went down this year when the S&P went down. I'm just wondering, what's the best way for me to think about what I'm doing when my account is down by, just 10 or 20% when the S&P goes down like that?
Well, there's some things we'll touch on here at the end. Some ideas to talk about with your advisors there at Sullivan and Company. But yeah, it's one thing about this year with what's caused the declines with interest rates rising so far this year is the bond market has performed poorly as well. So even if you're in a diversified portfolio with stocks and bonds, we haven't had that historic diversification benefit that we've seen in past years. We think that's likely to change a little bit as we go forward. So depending on your specific situation, your account, there may be an opportunity to do some of the things we're going to talk about, some rebalancing. If it's a taxable account, some tax loss harvesting to move into a like investment to, so you can recognize a gain, but still have long-term exposure. So I would encourage you to get together with your advisors at Sullivan, or we can talk to you as well. Look at your account individually and come up with a game plan. Does that sound good to everybody?
That answers the question, yes.
Okay. If we look just briefly at this next chart, so this is just looking at past bear markets. The good news is bear markets are shorter than bull markets. The negative returns experienced in a bear market are more muted than the positive returns gained in a bull market. The average bear market historically lasts approximately 15 months. The thing with a bear market is it normally ends as abruptly as it begins. And if you miss out on the early part of the reversal, 2/3 of the positive performance of a bull market historically have taken place within the first 9 or 10 months of a bear market end. So another case in point recently, if you look at the last one in 2020, we had a 34% decline, but it only lasted 33 days. So had you moved out of that, we've got a slide that'll show some of those return numbers, you would have missed out on a pretty quick rebound. So on this next slide, how do we manage around volatility in these declines in the investment markets? And probably the most powerful tool is time horizon. It can be a difficult thing to stay on track with in volatile times, but keeping a long time horizon is a powerful tool against market declines. And you can see in any 1 year period, if we look over there on the far left on a 100% stock portfolio, that's a pretty wide dispersion of expected returns, anywhere from a 39% loss to a 47% gain in any 1 year. But if you look out further and further out to a 5-year rolling time period, 10-year or 20-year, the odds are stacked much more in your favor. Even if we look, say, on a 10-year rolling time horizon on a very aggressive investor who's 100% stocks, that's a much narrower return, and 90% rolling periods, you would have actually had positive returns. So it's hard sometimes to say, to think do I have a 20-year time horizon? No, I'm going to retire in 5 years, but your true time horizon is just that 5 years, because you're going to need to continue to invest through retirement. Most people, life expectancies are moving further and further out. So most of us have a longer time horizon than we think, which is a good thing to combat this kind of volatility. On the next slide, KOBY, so one of the big elephants in the room, or the causes of the declines, have been interest rates. And over the longer term, higher interest rates, I wouldn't say, it says they don't phase stocks. Clearly they phase stocks, but over the longer term, there's not as great an impact on investment returns as you would think. These are the last 5 rate hiking cycles dating back to 1994. You'll notice that 4 of the 5 actually are positive 1 year later. The one exception being in 1994, where it was down a little bit less than 1%, so about a break-even return. But you can see in the early part of the cycle, as you look further to the left there on the chart, there are some declines as the market adjusts and gets used to rates rising. And that's been, I would say, particularly the market's been trying to digest that because of the pace with which rates have risen. So, today we're having a pretty healthy day in the markets on the heels of some a little bit better than feared inflation numbers, which kind of feeds into the consensus or the general feeling that while they may not, you hear a lot about the pause or pivot, while that may not be in the immediate offing, the general expectation is that gives the policy committee an opportunity to at least slow down and not be quite as aggressive with rising rates. If we take a look at the next slide, and this is kind of the second thing that investors have been hit with, is the election cycle. So I guess we're not completely done with the election, but this year, the second year of the presidential election cycle, is historically the worst year for the market. If you look, you can see the drawdowns are bigger, the average decline of minus 6.7%, and the positive returns are lower, of 5.3%. Certainly, if you compare that to the other 3 years in the cycle. The good news is that year 3, pre-election year in the presidential cycle, has been the best year for investors, both in terms of returns at 18.5%, and this is going back to 1970, and with declines of smaller drawdowns. So that's some good news as we move through this cycle. On the next slide, we kind of drill down on that a little bit further, and just looking at it quarterly, we're in Q4 of year 2 of that cycle. So we're just getting into what's historically been 3 of the best quarters for investors during that cycle. So there are some reasons to be optimistic here over the next few months, as we have some of those seasonality and cyclical factors working in our favor, particularly if we were to couple that with at least a slowdown in the pace of increasing interest rates. If we go to the next slide, KOBY, this is as tempting as it may be, and we're hit with plenty of information to try to do it. Whether you're looking at who's making inroads in a war, or how much and how often and when the Fed's going to raise rates, who's going to win the election, is there a recession this year, next year, COVID, whatever it may be. Few, if any, over the long term are successful at trying to time the market based on any of these kind of factors. And the reason is you've got to be right twice. It's hard enough to be right once, but you've got to be right, 1, when to get out, and 2, when to get back in. And that's amplified even further that most of the best days in a market come right after a bad day in the market. So, if you look yesterday, we had a bad day. Today we're having a good day. If you would have sold yesterday because you were scared, and now you want to buy back today, you're giving up an awful lot of performance rather than just staying put. Another good example again is if we look back to 2020, if you would have just missed the 5 best days of 2020, you would have ended the year with almost an 18% loss versus an 18%, a little bit better than 18% gain if you would have stayed invested for the full year. And we can see that this chart shows over 20 years. If you would have missed kind of that third bar over just the 10 best days in the last 20 years, had you invested $10,000, your return would have been less than half if you would have stayed fully invested. 28, you would have ended up with 28,000 versus almost 62,000. Look out a little further. If you missed 40 days, only 40 days in the last 20 years, you would have actually lost money. So we think it's a dangerous game to play and an expensive game to play to try to time the market. So it's kind of a cliche sometimes, but we try to emphasize time in the market is a lot more important than timing the market. So if we over to the next slide here, KOBY, just quickly. So where do we think things are going here? What are our expectations over and what drives those returns over the long term? And this is a relatively short time period that we kind of zoomed in on just so you could see some of the volatility. But over the long term, stocks follow earnings. As earnings move higher, the stock market marches higher. If we have some of these earnings recessions or decline in earnings, the market typically follows that. But the long-term trend for U.S. companies is increasing earnings, and the market follows along with that. We're kind of wrapping up the most recent earnings season. Generally speaking, earnings have been a little bit better than feared in the market. for 2023, particularly the early part of 2023. Some of the guidance we've received from companies has tempered a little bit of their growth expectations. Still expecting some growth, but not as robust as we were expecting in earlier quarters. But we do expect that growth to pick back up as we move into the latter half of the year. So what we're doing within funds and portfolios to try to protect against some of that flattening earnings growth in the next 2 quarters is really looking for companies with strong balance sheets, durable market positions, and sustainable earnings and cash flow. And that's largely because with the policymakers pulling some liquidity out of the markets, we think it's important to look at companies that can generate their own liquidity. And that's why you've seen disproportionately some of these smaller, high growth companies that are relying on outside liquidity struggle more than some of these stable companies with sound balance sheets and solid cash flow. So these last couple of slides, just a few opportunities that we'd encourage you to talk with the folks at Sullivan about, see if these make sense for you. Number one, make your IRA and retirement plan contributions. It can certainly be disheartening to be put into your 401k. You get your quarterly statement and you see that it's down. But this kind of goes into the buy low. If presumably if you're
Hey John, sorry to cut you off. I think Dan has a question.
Yeah, hey,
Oh, sure.
I'm not sure when the right point to ask this is, so I'll just ask it. If you're near, like, let's say you're like getting closer to retirement, you know, I don't know, 50s or something, and you're starting to look at like your glide path for increasing the bonds, and like, let's say you're like 10 or 15 years out or something, so you're starting to look at bonds, and you got to start getting serious about it. But then you see what's going on with like the market is choppy now, and I'm not anywhere close to this, but it's something that sometimes I think about. So like when you look at a market like this, but you still got a bit of a horizon, but you still got to start, you know, doing some like, you know, getting a little bit defensive. What do you do in that kind of case? Let's say it's like in a recession like is now. Do you like kind of delay going into bonds? Do you just proceed as you were always planning to, and maybe increasing by like 1% or 2% a year? Or do you just like plan on pushing out your retirement timeline? Yeah, that's that. Let me know if that question made sense or was clear. Thanks.
Well, yeah, I mean, it can be a combination thereof, as you can see, number 4, when you say pushing out your retirement timeline, that may be something you consider if that's appropriate for you. In terms of bonds, I can tell you, you know, right now you can get close to 4.5% on a 2-year bond when you would have had less than 1% a year ago. So bonds over time, we think stocks will perform better, but bonds certainly are a lot more attractive than they were just a year or 2 ago. So I think it makes sense to do a combination, you know, to review your portfolio, see how close you are to retirement. Again, your time horizon doesn't just end at retirement. Presumably, if you retire at 60, you're gonna live at least, hopefully, another, you know, more than 20 years. So it's important to account for that as well. You don't want to just switch and go to 100% defense. I think that would make a mistake. So does that answer your question?
Yeah, thanks a lot for the feedback.
Okay. So continue.
I also
Sure.
Okay, so what are the advantages of active management versus me just taking my whole account and putting it in an index fund like the S&P 500?
There's a couple of advantages. One, we think, as we've seen over the last year, active management has actually started to outperform passive management. That was not the case in years in the past. Just looking at purely just at active and passive in a vacuum. When we've been in an environment of declining rates, increasing liquidity, that tends to lift all ships with the sea as we move into these challenging environments where we think liquidity is going to be declining in the marketplace. Active management makes a lot more sense, and we can kind of tailor make investing portfolios by actively managing it to the investor. So there's a place, I think, for some of each in a portfolio rather than betting all on one or all on the other. If you look at the most popular funds, say an S&P 500 index fund, more than 20% of that index was made up from 5 companies. So that's a particularly in the environment we have a pretty big risk, we think, to be having that much of your investment experience tied to a small number of companies. But I think there's a place for both, but we think the environment, particularly now that value has started to perform better than growth with the rate environment and the liquidity environment we've got, we think active management will be a lot more important for the next few years.
John, can you explain, when you have active management, what's your job and what do you do at Archer regarding and performing active management, and how do you do it?
Well, yeah, I mean, there's a variety of ways we do it. Just in the settings of the funds, we try to combine both a top-down, a macro viewpoint. So no, we're going to lose it. Go Boats!
We lost you, John.
I had a question
the best
similar to the last person about active versus passive index. And, the thing about active is that it has to outperform not just the market, but also the management fee. And it has to do that over long term, which a lot of active funds don't necessarily have that track record. I'm just wondering what the appeal of the Archer funds is versus what the previous person said about passive index.
Yeah, sure. So, there are times when active management outperforms and times when passive management outperforms. And, you're right. So a management fee, typically a passive fund has a lower expense ratio than an actively managed fund. But if you compare, the total return, so after accounting for those fees, that's what we're looking for is over and through business cycles. Can the active management outperform passive management? And I would say coming out of the cycle that we've been in with abundant liquidity and declining rates, it's been a much lower hurdle for passive management than it has for active management. But going forward, we expect that to be to be different, and we've started to see that and realize that performance differential, granted over a reasonably short time frame over the last year or so here as the markets have shifted. But we think that there's still a place for both in a portfolio. So getting back just to touch on these last couple of things real quickly here. We talked about, on the glide path, or does it make sense to think about delaying retirement if that works for you? Consider investing cash that's sitting on the sidelines. As we saw, bear markets declines can reverse pretty quickly, and we don't know when the bottom's in until after it's already occurred. So it might be a good time to start dollar cost averaging into your investment portfolio. And then on the last slide here, we think this is a good thing to do with your advisor every year, but particularly in times of where we've had some big changes, is review your risk tolerance, your goals, your asset allocation if anything's changed. Work with your advisor and make sure that you're still on track for your long-term plan. It could be the case that if you've got a long time horizon and you can tolerate some of the ups and downs, it may actually be a good time to get a little more aggressive. Consider rebalancing. Volatile markets can create some imbalances, and make sure that again, when you have that review and talk to your advisor, that you're still in the proper asset allocation. And the next one, this would be more just for taxable accounts, but consider tax loss harvesting. So obviously you don't want to run afoul of the wash sale rules, so work with your advisor and your tax people to make sure you don't do that. But if you were in an S&P 500 index fund, for instance, and you've got some losses this year, you may be able to recognize that gain and swap into a different fund or exchange traded fund that's got very similar exposure and keep you invested in the market, but you can recognize that tax loss. And then finally, just something that a lot of people refer to as the stealth IRA. If you're eligible and it makes sense for you, consider opening a health savings account. That can be a good way to shelter and grow some assets for the long term for healthcare related expenses later in life. So that's what I've got. I'll turn it back over to you guys if there are more questions, or I'll turn it back over to you, Koby.
Yeah. Before we move forward, does anyone have any other questions they would like to get answered? Okay, give me a sec to set up the next portion of our webinar today. So hello, everyone. I've seen some familiar faces that I have spoken to before, but a lot of you I haven't spoken to before, so let me introduce myself. My name is Koby, and I'm new to the team here at Sullivan. I am the Wealth Management Advisor. Today, I'm going to be going over the services that we offer and some recommendations that I think that all of our accounting clients should take advantage of and participate in. So starting off, the first thing I want to talk about is just creating goals for each and every one of you. To that, moving on, I'm going to just talk about why everyone should have a financial plan. And then I will, to wrap up individual investing, we're then going to move on to business owners and how the new rules that Malin is imposing on retirement funds. And then to wrap it up, we're going to end it with our business retirement services. So starting off with goal creating. Here at Sullivan Wealth Management, we tell all our clients and prospects to create goals and stick to them. As new clients of ours, we work with you to fully understand your individual financial goals, and if you're a business owner, your business goals. During the onboarding process, we have an initial consultation with you, and during this consultation, we review all of your current investments that you may have, and we kind of go through. Sorry, I think someone has a question there. Yeah, sorry. And then to wrap it up, we identify both strengths and weaknesses in your current financial life. Once determining these goals, we recommend that we attack your weaknesses and help you work towards achieving those goals. So this slide just kind of shows 2 examples. Go ahead, sorry, with your question.
Yeah, I have a quick question for you, KOBY. So I currently have a financial advisor that I don't communicate with very often. What are the advantages of working with a financial advisor like yourself who also does my taxes each year?
Yeah, I think that's a great question. Just starting off, investing and taxes go hand in hand. You would want someone that knows your full tax situation to also look into investments because they know their situation the best. They can look for tax saving opportunities and just stuff like that. I think working with a wealth management advisor that is also your accountant is the way to go. I think, Paul, if you have anything to chime in, feel free to add some pointers on that.
Well, commonly there is not a lot of communication between accountants and if somebody has an independent financial advisor. If you think they blend, they generally don't. So when we handle someone's taxes, we end up asking them so many questions that we know everything about them. If they go to another financial advisor, they got to start beginning again. And even when I get calls from if they use another financial advisor, I have to talk to them for like 30 minutes to just get them up to speed. When they're with us, we already know all about them, and it is an advantage. When we have clients that use other advisors, we don't encroach. If they're comfortable with their financial advisor, we tell them to stay. But if anyone has any doubts, they give us their statements, and we give them a second opinion without any type of sales effort. It's a mere education and input. So that's always available, that they can have that, and that'll just give them a comparison to their current situation. Go ahead, proceed.
Yeah, does that answer your question?
That's a perfect answer. Thank you very much.
Yeah, no problem. So moving forward, this slide here just kind of has 2 examples of goals that you may have as one of our clients. So the first milestone would be is to save as much as you make annually. I know this is kind of hard to put in picture, but if you make $100,000 per year, an example of a goal would be to save and invest 10% of that. So $10,000 per year. With each person, their situation is totally different. So your number could be anything that you can come up with. But milestone number 2, we think this is very important, is to maximize your retirement accounts. So what does that mean? So starting off with your 401k, if your employer has a 401k at work, we highly recommend that you participate in that plan. Most plans have a match of up to 4%. And with your contributions and the employer contributions, we think, taking advantage of that is the way to go. As of 2022, the max you can invest into your 401k is $20,500. And if you are age 50 and above, you are able to invest $28,000 total. Starting in 2023, the IRS has actually increased those limits. So starting next year, you're able to contribute $22,500, and then if you are over age 50, you're able to contribute $30,000. So once you maximize your 401k, we recommend that you contribute any leftover income to an IRA. As of 2022, the annual limit is $6,000, but you are able to invest an extra $1,000 if you are age 50 and above. With an IRA, there is an option called a Roth IRA. What this means is that any contributions made to that account is tax-free in the future. We highly recommend that you put a predetermined amount per month that's automatically withdrawn from your bank account to an IRA. And then moving forward, if you do have the ability to max out your 401k and your IRA, we recommend that any leftover income after paying your monthly bills, investing in your 401k, as well as your IRA, we recommend to open a taxable account, which is also called a brokerage account. There is no tax advantage of starting these accounts, but individuals with high income should put any leftover income into this account. Before we move forward to the next slide, does anyone have any extra questions? Okay. So moving on to the next slide. Why should you have a financial plan? We coach each and every one of our clients in a roadmap so that they can see their goals being accomplished day after day, month after month, and then year after year. One of the benefits of being a wealth management client of ours is the access to a free financial plan. So let me explain what a financial plan is. It's essentially a document that contains your person's current financial situation, any investment accounts, monthly income, and then it takes into account your long-term goals as well as strategies to help you achieve those goals. So the first step of starting a financial plan is we take into account what you own today, your current debt, and your net worth. After this step, we then project what may happen to your investments in the future, year after year. We make recommendations to improve your current and future financial situation. Just like as John spoke earlier, we are actively managing your investment account. So whenever we see a current event that happens, we make the changes necessary. Before we move forward, does anyone have any questions?
Hey, Kobe, I actually have a question. Can you hear me okay?
Yeah, go ahead.
So I'm a tax client, and I have some investments that I manage on my own. And my parents, who are near retirement, are also interested in investments. So I'm just curious, would a financial plan benefit me and my parents? And how would I go about doing it?
Yeah, I think that's a great question. A lot of people come to us that are either close to retirement or retired, and they would like to get a financial plan just because it kind of puts into perspective where they're at financially, and it helps them in the future. So to get started, just as Paul said earlier, we do offer a free second opinion of your investments. So you will schedule a consultation with me. You'll bring your any investment statements that you may already have, and then once we have that, we'll take a look at your accounts and come up with goals for you that I spoke about earlier. And then once we have those two things, we project those investments moving into the future, and we help you reach those goals.
Thank you.
Yeah, no problem. So let's move forward to business investing. I see we have a lot of business owners on the call here today, so I'm going to kind of give an update about the new Maryland Saves plan that Maryland has implemented. So this plan is a retirement program. This plan has started in September of this year. So Maryland is now requiring all businesses to provide their employees with their retirement. A few of you may have already received these notices in the mail, but essentially what it is, it's a retirement account that if your business currently does not have a plan, they help you enroll So they will be providing, if you have received one of these notices, they'll be providing you a deadline to either get a retirement plan or enroll into their program. So so to even receive a notice in the mail, your company has to follow these 3 criteria. Number 1, your employer doesn't already have an existing retirement plan. Number 2, you have been in business for at least 2 years. And then lastly, your business employs at least 1 person and uses automated payroll. If you decide not to enroll in Mail and Save, there will be a penalty for not enrolling. Since this law is still new, they're still in the process of determining this penalty and when they'll implement it. But we'll let you guys know on any new updates we have of this plan. So if your business decides to enroll into the Mail and Saves program, each paycheck, your employees will be auto-enrolled, and they would be contributing 5% to the Mail and Saves Roth IRA. So just as it says, auto-enrolled. So if an employee doesn't want to participate, they have to go and call Mail and Saves and then not participate. And so if your business has an existing retirement plan already, so what do? So the first thing you do is go online at mailandsaves.com and file that exemption. What that does is that doesn't require you to enroll into the program since your business already offers a retirement plan. So if your business doesn't already have a retirement plan and you would like one, here at Sullivan Wealth Management, we help businesses choose a plan that will benefit them. I'll go ahead and talk about those services later in this presentation, but before I move forward, does anyone have any other questions?
Yeah, hey, quick question. If we don't have any employees, like it's sole proprietor right now, do we still have to do any of the filing?
Yeah, so as a sole proprietor, you do have to, what you can do is you can either enroll or file the exemption.
Great, thanks.
No problem. Any other questions?
When's the deadline? If you don't have a plan now, when's the deadline that you got to do it by?
Yes, so just like I said earlier, Mail-in Saves has already been mailing notices, and so these notices they will say the deadline in the notice. So it could be what we've seen is that they give businesses about 2 months to come up with a financial with a retirement plan, but each business is different, and if your business does receive this notice in the mail, we recommend that you give us a call and we can walk you through the steps.
I have a question. If you have a business with employees and you already have a retirement plan, but not everyone in the company participates in that plan, do you have to auto-enroll them in your plans with the same 5% contribution recommendation, or maybe it's more than a recommendation that Maryland Saves IRA has? Or just by having a plan available to them, do you meet the exemption requirement?
Yeah, so that's a great question. I think a lot of businesses will face this issue moving forward. But since your company already offers their employees with a retirement plan, all you would have to do is go online at mailandsaves.com and file that exemption.
Right, but so it doesn't matter that maybe only half your employees are on the plan. The whole company is exempt.
Right. As long as you're offering all of them a retirement plan, you're squared away. And the ones that don't decide to participate, they don't have to be enrolled into Maryland State.
Okay. Thank you very much.
Yep. Any other questions? So this slide just kind of goes over Mail and Save disadvantages. So the main disadvantage is that it's a headache for employers. Each pay period, employers will have to set up a contribution in their payroll and then send it to Mail and Save, and then Mail and Saves will have to start the contributions. This can be a huge hassle, and it will be very easy to mess up. Another disadvantage is that mail-in saves IRA, it's only a Roth IRA, so each year your max contribution limit is only $6,000. Versus if your company had a 401k, that limit is $20,500, and then so forth and so on. So the next disadvantage is that there is only limited investment options to choose from. Mail-in saves is only offering its participants with only 12 funds to choose from. So if you had a 401k, you would have access to all funds available. Unlike having a traditional retirement plan like a 401k, mail-in saves Roth IRA does not have any tax saving opportunity. And then moving forward, if your business decide to enroll into the program, all your employees are auto enrolled. Even if they don't want to participate, at first they are auto enrolled, and then if they want to not be enrolled, they'd have to call mail and save and unenroll. So the question that comes to my mind is, what do you do as a business owner if you currently don't have a retirement plan for your employees? So as a part of our wealth management services here at Sullivan Wealth Management, we help businesses with their retirement plan. The first thing we do is we hold a meeting with the owner or owners of the business and review their company's financials to determine the best plan for their company. The options, some of the retirement plan options include a 401k, SEP IRA, or a simple IRA. These three plans are extremely different, but we walk the owner through setting up the best possible plan for their business. Once choosing the type of retirement plan, we then host a sign-up meeting with the owner and their employees. We give details about the characteristics of the plan, whether it's a 401k, SEP, or simple. We go with the details with the employees, if there's an employer match, how much they are able to contribute, the investment options that they do have when enrolling. In addition to that, we do offer payroll services where our payroll advisor at Sullivan will help the business owner set up their holdings on each payroll for each employee. In addition to that, we do consult on investment options. We are the home base for your retirement plan. Any questions that you as the owner may have or the employees may have on their investments in the plan, we can give a second opinion on, and we can help each employee set up their investments. In addition to these services, we do provide online access to these accounts. So your employees will have the ability to log online and see their accounts grow. Just as John was speaking about earlier, if your business decides to start a retirement plan with us, we do actively manage your investments. Any changes we see in the market, current events that affect the market, we will tweak your investments so that way that you guys don't suffer any of the backdrop. The main thing that we do offer is an annual in-person education meeting for the owners and any new employees that the firm may have gained over the past year. During this meeting, we go over the characteristics of the plan and answer any questions that the employees may have. Does anyone have any questions about those items?
For Maryland
Yeah, I have a
Saves,
question.
Yeah,
I want to add, for Maryland Saves, there's no employer contribution, correct?
No, there's no employer contribution,
Just
only
employee
employee contribution.
Right, I understand. Okay, go ahead.
Yeah, what kind of payroll services does Sullivan offer? I didn't know about that.
Yeah, so I think Paul, would you like to answer this one, Paul?
I mean, we offer a full automated payroll service. There can be situations when a company can go directly to a payroll service. Many companies, especially if they have, say, 1 to 10 employees, have trouble with 1-800 payroll. So when things get fogged up, it's can be difficult to get through to the payroll service, to get through to the government. But for given applicable situations, we offer payroll services like any other payroll service. And one of the advantages, if we do their accounting, and everything is coordinated together. So they just have to dial one place to talk about accounting, taxes, payroll, whatever it might be.
And then also, do you manage the? And I know you manage the 401k, but do you have a fund like ADP does as well for 401k?
Ask the question again.
I know you manage our 401k, but you have through ADP. But do you, like, if we don't use ADP and you do the payroll service, is there a fund where we would move our money to the 401k?
The ADP, the platform, for some clients that use ADP for payroll, we manage their 401k through the ADP platform. But the investments are the same as what we offer if they handle the payroll with any payroll service, or if they do it internally. So it's not just with ADP. When we get a client that where they're using ADP as payroll, they just add us to the list of advisors on the ADP platform.
Got it. So you guys have your own platform as well?
Correct.
Okay, thank you.
Hey, Koby, a quick question.
Yeah, go ahead.
As a small business owner who doesn't have a business retirement plan set up, I hear that they can sometimes be a headache to administer and deal with. I was wondering if I set one up with Sullivan, how would you be able to help me with this process?
Yeah, I think that's a great question. So if you were to set up a retirement plan with us, we are, like I said earlier, like we are your home base. We handle everything from setting up the plan, educating the employees on the details of the plan, their investment options. We set up it on payroll for you. We do the withholdings for you. The only thing you have to do really is just choose the type of plan. Like we're your home base. We answer any of the questions you may have. And overall, we guide you throughout your journey as a company to provide a retirement for your employees.
I see. Thank you.
Yep, no problem.
I mean, you got to keep in mind that a business owner can call one of the stockbrokers' house and set up a 401k directly. The challenge is the business owner is has a fiduciary responsibility for the employees' payroll accounts. So generally, in order to not have that responsibility, he hires somebody like us. And that way, he's not talking to the employees about the plan. They talk to us. So that's kind of when you have a business and you have employees, you know, your employees can't, in general, many of them can't call 1-800 and try to pick investments. They need an individual person basically to give them education, depending on the people. And sometimes we have people that are pretty sophisticated, and sometimes we have people that need education. So we're like a third party that supplies that education that relieves the business owner of his fiduciary responsibility by hiring us.
Do you guys administer the plan then?
We administer the plan. We use a third-party administrator, which does things like record keeping and files the tax forms and keeps the accounts separate. But we deal with them directly.
Does anyone have any other questions? Yeah, so I'd like to thank each and every one of you for attending this webinar. I hope that the information that me and John provided is going to help you in the future. If any of you have any questions regarding your current investments, would like to take advantage of that free second opinion, just feel free to send me an email at kclark@esullivan.net or give me a phone call at 316-355-3535. And if anyone has any other questions, feel free to let me know.
Thank you.
Thanks, Kobe.
Thank you very much.
Thank you. Take care.
Thank you.
Thank you.